Welcome back to Morning Markets on Thursday, the 6th of January. On screen, we can see the key market moves from yesterday. The key takeaways were a positive day for UK equities, supported by mining and energy companies. It was a positive day for European equities, supported by the auto sector. The sector had a strong 2021 from a profit perspective, despite chip shortages requiring many companies cutting production. Why? Because healthy consumer finances were in place, which offered scope for manufacturers of vehicles to pass on those higher costs to consumers, allowing them to maintain margins. This year, investors are more bullish that supply chain challenges to start to ease through the year and consumer demand remain robust. In the US, markets were more challenged as investors reappraised the impact of higher interest rates on those companies which are more sensitive to earnings expectations. A key example yesterday was the technology sector, with the Nasdaq down 3.3% on the day. This also suggests that investors are not anticipating a full lockdown type environment, which 2020 will tell us was beneficial for those technology companies and those companies embracing technology. So investors looking past that environment and not rushing towards the tech sector. The US dollar was slightly weaker on the day relative to the Swiss franc, the Canadian dollar and the Swedish krona, but remained strong relative to sterling and the euro. Sovereign bond markets in the UK in general round-tripped in terms of where yields got to. However, in the US we experienced higher bond yields, with 10-year treasuries rising 5 basis points to 1.7% and shorter dated bonds, which are more sensitive to central bank interest rate expectations, rising 6 basis points to 0.82%. For context, the US 10-year treasury yield has risen around 17 basis points since the end of 2021. You can see this on screen in the following chart. In the top section, the heavier green line demonstrating the yield curve as it was yesterday. The dashed yellow line is demonstrating the yield curve on the 4th of January. The bar chart in the bottom section of the chart demonstrates the move in yield. Here you can see the bigger moves were seen at the front end of the curve, so 2 to 7 years. Why was this the case? Yesterday we received the minutes from the December meeting of the US Central Bank, the Federal Reserve. We'd already seen the outcome of the December meeting, where they retired the word transitory from their inflation discussions. They agreed to reduce the pace of quantitative easing from the market with a view of hiking interest rates 3 times in 2022 and 3 times in 2023 to combat inflationary pressures, to moderate their balance sheets and to really rebuild monetary policy levers after they were fully opened to support liquidity in the markets in reaction to the pandemic. The minutes from yesterday really just emphasised the support from Fed members towards this approach, who are gaining comfort in the economic data which they're seeing as we move towards their objectives of maximum employment and inflation at a rate of 2% over the longer term. Yesterday we received the jobs report from provider ADP. The report provides a positive picture of the health of the labour market, for which the Fed needs to digest in effect. Private sector businesses in the US added 807,000 workers in December 2021, despite that backdrop of rising Omicron infection rates. This was more than double the level the market was expecting, and what was interesting was the job creation was not just in one specific sector, it was quite wide across the marketplace in service sectors such as hospitality, leisure and transportation. Full employment is one of the objectives of the Federal Reserve, and whilst there remains debate around what that level is, with a number of US citizens leaving the workforce through the pandemic, it provides a healthy and important discussion point for the Fed members to analyse and to debate as they vote on their next steps of monetary policy. That's all for today. Thank you very much for watching, and we look forward to bringing you up to date tomorrow here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.